So good morning, everyone, and thank you for joining us this morning for our 53rd installment of EO Exchange. And today we have our strategic alliance partner, AllianceBernstein. And it is crazy times in this country. So we're all curious to see what AB has in their crystal ball for our economic outlook. So let me tell you a little bit about Eric and Adam, who will be sharing with us this morning. Eric Winograd is a Senior Vice President and Director of Developed Market Economic Research. Prior to joining AllianceBernstein in 2017, Eric was the senior economist at NKP Capital Management, a U.S.-based diversified alternatives manager, and also served as the senior macro strategist at HSBC North America. Earlier in his career, Winograd worked at the Federal Reserve Bank of New York and the World Bank. He holds a BA cum laude in Asian Studies from Dartmouth College and an MA in International Studies from the Paul H. Nitze School of Advanced International Studies located in New York. Many of you know Adam Cinceveri, who is a Senior Managing Director, head of the National Private Wealth Group at AllianceBernstein. Prior to joining AB in 2010, he worked as a Broadway producer and financier on over a dozen plays and musicals, which garnered multiple Tony Award nominations. Adam is a serial entrepreneur, founding 2 different companies and investing in over a dozen. He holds a BS cum laude in biochemistry from Cornell University, where he was a 2-time Ivy League track and field champ and was awarded the academic All-American designation. Adam also holds an MBA in economics and media management from the Fordham University Graduate School of Business. He is proud to be serving his 2nd term on the board of directors at TPAC, as well as Studio 10 in Franklin, Oz Arts, and the Heritage Foundation. He was appointed by our governor to the Digital Media Advisory Board for the Entertainment Commission of Tennessee, as well as appointed by the mayor to the Business Advisory Committee on Climate Change and the committee to help establish a new office of music, film, and entertainment. So thank you both you guys for joining us today. We will have time for questions after the panel presents. So please put your questions in the chat and I will share them with them at that time. And Adam's going to kick us off this morning. So take it away, Adam.
Thank you, David, and thank you for that very warm introduction. It's always funny to hear people say that. It feels like a lifetime ago being in different careers, but 14 years at AB, and it's been an amazing 14 years, but the best has been the past 6, being in a Nashvilleian. So first, again, thank you to all of you for having us. Thank you especially to our EO members that are clients of the firm. You have been some of the best partners that we've had in this community. We always look forward to doing these things, and we always really look forward to our forum visits with you all. So please continue to reach out and get us scheduled for any forum visits on whatever topics that may be interesting to you for the second half of the year. For those of you who I've not met or have not heard us speak before, a quick reminder that AB is the largest independent financial research firm in the world, and we are the only global asset manager headquartered in Tennessee. Since our relocation in 2019, we now have over 1,250 employees in town, have representation on over 100 nonprofit boards in town. We have now almost invested $1 billion into the state of Tennessee and are managing over $5 billion for clients now in Nashville. We are thrilled to be active members in this community and to be helping so many entrepreneurs realize their dream and their impact. I'm very excited about today's discussion. I just want to say up front that this is by no means a sales pitch. This is a conversation all around the economy and how it's either helping or hurting your businesses. There is so much happening in the world today, as David alluded to, from the Fed to a very dramatic presidential election to wars and AI, to name just a few. So I know there's a lot on everyone's minds. Again, this will be a very productive conversation if we can get to your Q&A. So that's the plan. We want to spend approximately 20 to 30 minutes with remarks, and then we'll open it up to the group. So we look forward to getting to that. So thanks again for having us. And with that, I'll turn it over to Eric.
Okay, thanks, Adam. Thanks all of you for joining. First, I want to say it's always wonderful on a Friday morning when you can learn something new. I did not know that Adam had been a Broadway producer. So learning something interesting about a colleague and something that's sort of fun about a colleague is better than the things one normally learns about one's colleagues, I think. I am going to spend a second here and try to share my screen. You'd think 4 or 5 years into the pandemic, post-pandemic era, we'd be good at this. And there we go. Everyone can see that, right?
Yep.
Yes? Okay, perfect. So look, as Adam said, we've got 20 odd minutes that I'm going to talk for. And in an environment this dynamic and this sort of fluid, there's no way I can cover everything that's going to be of interest in 20 minutes. And so rather than trying to run long, I'm going to try to run short and stick to the 20 minutes so that then we can have a discussion and you can ask me the questions that are most interesting to you, whether it's something that I did cover that you would like me to talk about in more depth, something that I didn't cover that you thought I should have, or something you think I'm wrong about. One of the great things about economists is that we're wrong a lot, and it's not offensive to us to be told that. We're used to it. It comes with the territory. And a lot of the best discussions we have internally are when we disagree about things. The old joke is, what do you get when you put 2 economists in a room? You get 3 opinions. And we want to make sure to be open to those different things, because none of us in our crystal ball, as you put it earlier, none of us has a crystal ball that's perfect. And we're not going to be able to look into the future and tell you exactly what's happening. I'm going to try to give you our best sense of what's happening. And then I'm going to spend the second half of my remarks talking about longer term challenges that we face that may or may not be an everyday preoccupation for you, but are the things that when we look back on this era 5 or 10 years from now are the things that I think we're going to be thinking about more than the here and now. But let's start with the here and now. And I promise not to read all the words on this slide. I've left it up there long enough that you probably could read most of them. But I do want to lay out the basics of how we see the economy evolving. Our view is, as it has been, that a soft landing is the most likely case. And by soft landing here, I mean that the economy can rebalance without a recession ensuing. And I recognize that that is contrary to the historical experience, which is that normally when the Fed has to raise rates, normally when you have an inflation shock like what we have had, you would expect that to end in a recession. We don't think that that is likely to happen this time. And I'll talk a little bit about why as we move along. Key to that view is the idea that disinflation will continue. And I want to be clear here when I say disinflation, economists, when we talk about inflation, we don't mean prices. And I know that sounds counterintuitive. We mean the rate of change in prices. So when I say disinflation, what that means is I still expect prices to go up. I just expect them to go up more slowly. The good news is that that is happening. We got an inflation print yesterday morning that I think was very convincing on that front. That was the softest inflation print we've had in 4 years. So there's good evidence that this process will continue. And that's critical to the outlook because that allows central banks to start cutting rates. And I know that a lot of business owners, particularly entrepreneurs, have been constrained by the interest rate environment, that the cost of capital has gone up significantly. We expect that that will come down in the coming years. The Fed is likely to start cutting rates in the next couple of months. Other developed market central banks already have. And as long as inflation continues to move lower, as we expect that it will, they will continue cutting interest rates. From a financial market perspective, it's funny because so much of the media, and I had a radio hit this morning where the question is basically, when's the first rate cut going to come? Is it July or is it September or is it? Who cares? I mean, honestly, really, unless you are a very, very short-term financial market trader, who cares? It overestimates the power of a small rate cut to think that it makes a difference whether it comes the last week of July or the second week of September or whatever. The important thing is that the rate cuts are coming. And I think you've seen in the resilience of financial markets and the strength of equity markets this year, the idea that as long as the next move is a cut, things are going to be okay. And markets have responded accordingly. And then this last bullet, I'm just going to leave on every slide that I put up there. It's like a source or a disclaimer. Political risk is elevated. I will talk about the upcoming election a little bit, simply because we've gotten into the second half of the year and I can't avoid it any longer. I mean, I believe me, I've tried. But I do think we need to talk about what the election could mean going forward. And so I will a little bit. I'll start by showing just a few slides to sort of lay out where we are on the here and now before getting to what I think is the interesting stuff. As of yesterday, inflation as measured by the CPI index is below 3%. It's the first time since 2021. You can see that it moved steadily lower over the course of last year, late last year in particular, sort of stalled out early this year and has resumed its progress. We think there's more to come. And one of the big reasons for that is that the primary driver right now is shelter inflation, it's house prices. The left chart here shows what inflation would be if we didn't count house prices, if we didn't count shelter inflation in that. And I'm not saying that that's how we should do it, I'm simply using that to observe that the underlying inflation dynamic has normalized. Leaving aside shelter, we're roughly back to 2% inflation, which is the Fed's target. Of course, you can't leave aside shelter. It is a big part of what people pay for, whether through rent, through house prices, what have you. And as you can see on the right, shelter inflation, which is the purple line, is still running well above where it needs to be. Sorry, it's on the right side of the index. So it's running over 5% per year. Well, with the 2% inflation target, that's obviously not where we need to be. The good news is that shelter inflation does resonate to house prices. It just takes some time. When house prices go up or go down, it takes about 15 to 18 months for that to feed through into the way we measure inflation. And I won't bore you with the explanation of why. That's pretty deep in the weeds. There's some of my favorite weeds, if we're being honest, but it's sort of beyond the scope of what I want to talk about right now. The key thing to observe is, look, that purple line is gradually following the yellow line, generally following the yellow line lower. We think that that'll continue, and that should allow for overall inflation to return to the Fed's target. And as it does so, we think that that will allow the Fed to start cutting interest rates. Why would they want to cut interest rates? A big part of that is that the risks around the economy have become more balanced. Last year, the economy grew more than 3%. The labor market was extraordinarily strong. And while it is still strong this year, it's not as strong as it was last year. The left side just shows the rate of hiring. The first Friday of every month, we get new data on how many new jobs have been created on net in the economy. Coming out of the pandemic, when so many people lost their job, we were obviously running at an unsustainable rate. This economy doesn't need to add 4, 5, 600,000 jobs a month. We're now running closer to 200,000 jobs a month. And that's still a lot by historical standards. That's still strong, but it isn't nearly as strong as where we were. It's a much more sustainable rate. And when you're running at a sustainable rate, the risks are necessarily more two-sided. When you're running at 500, a slowdown doesn't bother you, right? But an acceleration makes you worry about overheating. When you're running at 200, a slowdown starts to be a little bit more concerning. I want to focus just briefly, though, on the slide on the right side, which shows the distribution of hiring, of new jobs, of job growth going back 15 years, give or take. The phenomenon that is the most striking is that coming out of the pandemic, over the last 4 years, the entirety of job growth in this economy is attributable to foreign-born workers. That is important, and I'll come back to that when we get to the political section, but I want to be clear first. It is not the case that what this means is that foreign-born workers have been taking jobs from domestic workers. Remember that the native-born workforce is simply much, much older than the foreign-born workforce. The baby boom generation is aging out. Demographic trends are what they are. The growth rate of the working age population, excluding foreign-born workers, is 1 or 0.2%, right? The demographic trends argue that we should not be adding jobs at all, except insofar as we are able to bring in workers from overseas. If you think back 2 or 3 years, the dominant narrative around the labor market was what? It was labor shortages. It was businesses not being able to find people to hire. That has not been the case over the last couple of years, largely because there has been a surge in inward migration. I know that immigration policy is a very controversial political topic. Immigration is not controversial economically. It boosts your labor force, it boosts your potential growth rate, and it's a good thing if your objective is economic growth. And I want you to keep this in mind because obviously when we turn to the election, one of the policy axes that we have to consider is the future of immigration policy. And that, as much as anything else, I think matters to the business sector. So I will come back to that. It isn't just the labor market that's stabilized, though, that has become more sustainable. It's the growth side of things. I said last year that the economy grew more than 3%. Our estimate is that it'll grow around 1.5% this year. That's probably a little bit below potential, right? We're talking about a soft landing, but still a landing. We think of 2% as roughly a long-term average. So 1.5% is a little bit below that, but not disastrous. You can see that really in the middle chart, where coming off of a period of very strong spending by consumers, we're now sort of bouncing around at a normal-ish level, something that looks more like what we expect to see historically. And we expect that to continue. And look, the consumer is 70% of this economy. If the consumer is normal, economic growth is largely going to be normal. So all that sounds pretty good, I think. Most people are happy with the idea of an economy that rebalances, of a labor market that stays strong, of inflation that comes back to normal, and all of that being accomplished without there being a recession. How have we managed to do that? The first way, as I said, was net inward migration that has allowed for the labor force to cool even as businesses have been able to find new workers. The second part is fiscal policy. We are running extremely large deficits by historical standards. And I think this is not new news. I think everyone's well aware of this. The Congressional Budget Office forecasts deficits to remain elevated for the better part of the next decade, running 6% of GDP. That's a level of deficit that we in the past only ran during wartime and its immediate aftermath. So we are running a budget deficit that has been supportive of that soft landing. But look, the very first lesson I learned in the very first economics class I took is that there ain't no such thing as a free lunch, right? Everything you do has a cost. And so running a deficit this large has been useful in engineering a soft landing, but it comes with a cost of steadily rising government debt. Debt to GDP is at or around 100% now and is going to keep going up. There's no particular other. We again relying on the CBO forecasts. Debt to GDP is going to head over 150% within 20 years or so, and based on current policy, is likely to continue going up. These deficits are being run for a combination of reasons. One is the government spending, certainly during the pandemic surge, as you would expect. Traditionally, you get counter-cyclical spending when there is a negative economic situation to try to get the economy back on its feet. But even post-pandemic spending has been above the pre-existing trend rate. The other side of that, though, is that revenue has been constrained as well. Revenue has fallen below the long-term trend as a result, largely of tax cuts that were passed in 2017. And the government is like anything else. It gets money in and it sends money out. The amount of money coming in has gone down because tax cuts were enacted, and the amount of money going out has gone up, and the result is a very large deficit. And so when you look at this, the obvious thing to say is, well, why can't we fix that, right? Shouldn't we be able to do something, we as a body politic, to address these things? And it's hard. My answer, frankly, is no. One of the things I don't expect to change as a result of the election is the top line for fiscal policy. I don't think that it matters very much who wins the election. We're likely still to run a big deficit. We'll get there different ways, right? I suspect if we have a Republican-dominated government that we will have tax cuts that offset spending cuts, but that you end up at the same place. And if it's a Democrat-led administration, you'll have tax hikes that offset spending hikes, and you'll end up in the same place. And that means the government debt is likely to continue to grow. The issue here isn't that necessarily that either party is irrational, it's that they're rational. The truth is that fiscal reform and the things that we would have to do to balance the budget aren't popular. Nobody's going to vote for those things, right? And the reason is, look, let's look at what it is the government spends on, right? Essentially, the government is an insurance company with an arm, right? If you want to cut government spending, you have to either cut the insurance functions or you have to cut the army functions. So you start looking through this. What is it you're going to cut? The insurance functions, Medicare, Medicaid, Social Security? I mean, how popular is that? Neither party is interested in cutting either of those things. Are you going to cut welfare, income security programs? I mean, you can try, I suppose, but they're trivial in size compared to the other ones. You're going to cut veterans programs? I don't think that's going to be particularly popular. Military spending, again, that's not really going to win you a lot of votes either. You're left with that yellow bar at the bottom, non-defense discretionary. The problem there is, one person's pork project is another person's critical spending. That's a small slice. There isn't enough there that you can cut to really balance the budget or even come close just by cutting spending, right? So if you're going to try to do this by cutting spending, you're going to get yourself thrown out from a congressional perspective. And the same is true on the revenue side. Where do you want to increase revenue? Payroll taxes, right? Income tax, corporate income tax. Where is it that you think it's going to be popular for people to, people very rarely vote for tax hikes in any case, and they're particularly not going to vote for one if it's a tax hike on them. So if the voters don't like spending cuts and they don't like tax hikes, what are you left with? Right? Well, you're left with a big budget deficit. And that's where we expect to be. And that feeds into the political side of this, right? Because our body politic is driven by what the voters want. And what the voters want is increasingly what we would define as populist. And I want to just back up for a second before I get to the US specifically and observe that it's not just the US where elections matter. More than 40% of the world's population has gone or will go to the polls this year. These are the elections we've had that are scheduled over the course of this year. And we have already had market-moving surprise results in several of these countries, in Pakistan, in India, in France most recently. All of these different electoral surprises have had one common theme, which is that voters are increasingly populist. The one exception to that is the UK, where they had sort of an anti-populist election, which I would say in this case was sort of post-populist. They had their populist moment when they voted for Brexit and have regretted it ever since. And that was expressed at the polls earlier this month. So when we think about our election, when we think about our politics, I would focus on this dynamic. We're used to thinking about our politics as left versus right, Democrats on the left, Republicans on the right. And I've listed, there are the different policies that you would expect from those different political parties. The truth is that the axis that matters right now isn't the left and right one, it's the north and south one. Right? It's populist versus sort of cosmopolitanism, if you will, or a classical liberalism. And if you look at the things that are in those different boxes as policy prescriptions, I think that you can see which is in the ascendancy right now. Populism generally is designed to favor, or it claims to favor, the little guy, workers, not businesses, us, not them, whoever, however you define us, right? Whether it's national, whether it's economic, whether it's local, but it's us, not them, and trying to share the spoils of a country's wealth with the little guy to redistribute, if you will, down rather than up. And that's sort of the north side. And I've drawn this intentionally the way I did because I think it sits above both the left and the right, and both parties are pulling different parts of that populist impulse into their platforms. And so as I said, I have to talk about the election. There's no safe harbor for me to do that without angering people. So what I try really hard to do is to focus on policies rather than politics. And so what we've done here is break down the policies, the policy channels that populism drives into three broad categories up top. And as I sort of walk through these, I think you'll find that many of the policy prescriptions you see there sound very familiar. So on the left side, where it says raising the drawbridge, to be fair, we probably could have picked a more modern image than a drawbridge, since I'm not sure how many drawbridges exist in the economy today, but I think you get the gist of it. The idea here is to prevent the flow of goods or to reduce, to minimize, to mitigate the flow of people, goods, and capital across borders. And that can manifest lots of different ways. It can be stricter border enforcement. It can be immigration restrictions. It can be limitations on foreign investment. We've seen pushback. The state of Florida has made it, if not illegal, certainly very difficult for people from other countries to buy real estate. So you can see the limitations on the flow of capital, and of course, trade policy, tariffs. One of the things that Trump has been most explicit about from a policy perspective is that he intends, if elected, to impose much stricter tariffs. All of those are classical policy responses to populism. That's what you would expect. The middle box is institutional erosion. What you generally find in a populist environment is that the reason it exists is that people don't believe that the existing institutions represent them. And so the people who are elected or who come to power as part of a populist movement aren't beholden to those institutions. And that can be anything. In the case of the US, we have seen questioning the democratic process, questioning the legitimacy of elections, questioning the importance or the existence of checks and balances, the idea that the executive branch, which is most accountable to the voters, or at least most prominently accountable, should have more power and shouldn't have its authority checked by the judicial or by the legislative branch. The frustration that a leader can't do everything they want to do in some senses. From an economic perspective, the Fed is an independent agency, and there's a lot of evidence that independent central banks generate better economic outcomes. But again, in a populist moment, it is correct that the Fed is not accountable to voters. And so the erosion of monetary policy independence is something that we have seen in many countries and could see in the US. And then finally, redistribution on the right. Look, if it is us against them, one way that that can be defined is workers against owners, workers against businesses, multinational businesses, conglomerates, simply big businesses. Who knows? The poor against the rich, if you want to put it that way. And so how does that get addressed from a populist political perspective? Higher taxes on the rich, higher corporate taxes. You could have higher minimum wages. You could have greater labor market regulation. You could have a push for a universal basic income. You could have a return of collective bargaining to give the little guy a voice. I'm not saying that all of these happen in every country, but these are the types of things you would expect. And from an economic perspective, the common theme that falls out of them on the red box at the bottom is that none of those have anything to do with fiscal responsibility. All of them cost money. None of them raise revenue. So you end up with higher government debt. You probably end up with higher inflation, because if you're trying to give people more money to spend, you could do 90% of my job as a US economist by just understanding that if American consumers have money, they'll spend it, right? So you get more spending, that's higher inflation, and you get less efficient growth, because you generally, not always, but generally end up with the government playing a larger role rather than the private sector. All of those things lead to less efficient growth. And that, to us, is the real outcome of this populist moment, irrespective of the election results. You'll get different flavors of it, and I'll conclude just by going through a couple of different ways that you could see this play out, because there are differences, wide differences between the parties. Look, the priority that you would expect from a Biden or a Democratic administration, these days I think you have to say Biden or a Democratic administration. When we wrote the slide, you could have just said Biden demonstration, but things change fast. Look, the priority from Biden or from a Democratic administration would be on redistribution. So the third block. And you've seen some of this during the first 4 years, or during the last 4 years of Biden's administration. Generally speaking, pushes for higher minimum wages, efforts to support unionization, pushes for greater regulation, whether it's environmental or others, trying to turn the environment into a populist issue. On a forward basis, if it is a Democratic administration, we would expect the 2017 corporate tax cuts to expire. They are scheduled to expire next year, and we expect that would happen under a Democratic administration. I don't think you should expect to see huge efforts at raising the drawbridge. This would be a case where we would expect policy continuity, and we would expect almost no institutional erosion. Populist moment or no, Biden is an institutionalist. He's been part of these institutions for his entire career. What's the economic impact? Again, because we don't expect a lot of change from the drawbridge box, we wouldn't expect there to be a particular impact there. Again, nothing from an institutional side. From a redistribution perspective, ending tax cuts and redistributing income to labor wherever possible are all going to be bad for corporate profit margins to the extent that they're enacted. I think that this goes without saying. No business, or none that I've spoken to, has ever said, yeah, what we'd like is to see a lot more regulation, higher labor costs, and so on. Additionally, passing additional expenses onto households could be inflationary. So big picture, if you think about what a renewed Democratic administration would mean, it tends to be this push toward redistribution. Play it the other way. If we end up with a transition in administration, what does that look like? Look, the priority there, I think, would be on raising the drawbridge and limiting the flow of goods, capital, people across borders. That's clearly inflationary, right? Less free trade means less efficient economic activity. A focus on domestic industry, particularly in an environment where fewer workers are available, that's an inflationary environment. We've seen financial markets respond to that likelihood over the last few weeks as Trump's odds have gone up, or on days when they seem to have gone up. Interest rates have generally gone up in the expectation that inflation will be higher. Institutional erosion. Trump is not an institutionalist, clearly. He is an outsider in every meaningful respect from a political perspective. I think that this is a slow burn. I don't think that it's not the case that Trump comes in and immediately all checks and balances are dissolved and the Fed is no longer independent. It would take some significant time to make meaningful changes there, but you would expect to see a deregulatory push that would presumably be good for corporate profits. bad for ESG and related sorts of programs. Eroding agency independence, particularly in light of the Supreme Court's decision around the Chevron doctrine, could add volatility because all regulations are going to be subject to change and businesses may not be able to plan as effectively. And over the very long term, eroding monetary policy independence would push greater risk premium into markets. It would be bad for interest rates in particular, which would likely move higher in the expectation that the central bank would be more political. And then finally, redistribution. This is not Trump's priority, obviously. He is almost unique among populists in that this is not something that he is interested in doing, not something he did during his first term. And so the results there that you would see, look, we would expect the tax cuts to be extended and made permanent. We would expect there to be hostility toward environmental rules, regulations, and you could extend that further to other regulations as well. What does that mean? Look, I think that would be good for corporate profit margins. I think that's an obvious thing to say. Deregulation, lower corporate taxes, all of which is good for profit margins. There's some possibility that corporate tax cuts could inflame populism. You would think that they should do, right? If people already feel that the system doesn't represent them, and then the system's response is to cut taxes on corporations that are already making billions of dollars. But it is a function, I think, of Trump's unique political genius is not too strong a word, that he has been able to talk like, act like, sound like, and be believed as a populist, even while implementing programs that, from this perspective, run contrary to historical populism. I'm not sure there's another candidate or another political leader I could think of who could do that. So I don't want to go too far down that path and say that it would happen. So let me stop with this. What do we think that the impact of policy changes would be? To the extent that the drawbridge gets raised, it's good for the dollar, it's bad for equities, and you end up with higher yield curves, higher interest rates. Institutional erosion, to the extent that it happens, pushes risk premiums higher. It's probably not great for financial markets, but that's a slow burn and not something where we would expect an immediate concern. And then finally, redistribution. The more aggressive it is, the more it hurts corporate profit margins, which makes it probably not good for equities in general. But if it happens, it favors companies and industries that generally serve lower income cohorts that would be the beneficiaries of it. So I'm going to stop there. I'm going to turn off my screen sharing, so you have to look at me. And let's talk. What I talked about a lot of stuff, but I didn't talk about everything. So what's interesting to you? I don't know how we want to manage Q&A. David, Adam, I'll leave that sort of up to you.
David, are you going to take it?
Yes, I am. There we are. Now I'm unmuted. So yeah, everybody throw your questions in the chat. I'll start off. Where do you think equilibrium interest rates will fall back to? Historically, they were always, 3, 4, 5%. And then we had, 15, 20 years of closer to zero. Yeah. Do you think we're going to go back to more historical, or do you think we'll head back down to the lower levels?
I think more historical. We have to, because we are required to write down forecasts for interest rates out a couple of years. I don't have a lot of faith in my ability to tell you specifically where it's going to be. But when I think about the terminal rate for this cycle, or the long-term average, I think that the policy rate for the Fed is probably 3, 3.25. And as you say, we've just come through a period where it's been steadily below 2 for a very long time. I think that means the 10-year interest rate will probably settle around 4%. There will be times when they're below, times when they're above. I think if anything, the risks around that are slightly to the upside because fiscal policy is so expansive and because the debt burden is so great. But I'm looking at a long-term new normal, if you will, that looks more like the old normal than the new one, than the most recent one. I think the last 20 years have been sort of a historical anomaly. For what it's worth, I think a slightly higher interest rate environment is a good thing from an economic perspective. I think that's something that the Fed has been trying very hard to make happen. And I think they'll be pleased with that outcome. It's a lot easier to manage the economy when you're starting with an interest rate of 3 or 3.25 than it is when you're starting at 1 or 1.5. And so I think that is a desirable policy outcome. And I think that's the most likely.
All right, I've got a question from Richard. He wants to understand, you said about shelter inflation continues to run hot. As we likely see rate cuts at some level relatively soon, would we not see gasoline on that fire and cause everything else to run even hotter?
So the real estate market has been the most perplexing part of this economic cycle. What you would have expected coming in is that if the central bank raised rates by 5%, as we did, and if mortgage rates went up by 6%, as they did, we're talking about a couple generations of home buyers who were used to mortgage rates in the 3s and the 4s, who are all of a sudden seeing 6s, 7s, and 8s. You would have expected home prices to collapse, right? They did not. They fell. So home prices went down as much as 6 or 7%, which is a reasonable size decline for a market that tends to go up. But they did not collapse, largely because the mortgage rate was so high that people who had homes didn't want to sell them, right? If you sold your house and had to buy a new one, you were trading a 3% mortgage for a 7% mortgage. It's a bad trade. So we never saw the supply come into the market in the way that you would have expected, given the environment. So we never saw prices fall the way that you would have expected. It is also true that as interest rates come down, we would expect housing prices to bounce back up. There's two issues to that as far as it feeds into inflation. One is it works with an 18-month lag. So we're still working through the declines from 18 months ago on the inflation front. So over the next 6-9 months, even if house prices start to go back up, the inflation measure of shelter inflation will still go down, right? 2 years from now, it'll probably start to go back up to reflect house prices going back up, but that lag is significant. The other thing to take into consideration here, though, is it's sort of the opposite of the supply constraints that we saw. There is good evidence that new home construction is exceeding near-term demand for it. We measure the state of the market in terms of the number of months of supply. And the number of months of supply for existing homes is still very low by historical standards, 2 or 3. People still aren't selling. As rates come down, they may, but they aren't. The supply of new homes is at 9 or 10 months, which is way above where it normally is. So it looks like there's a little bit of overbuilding. We also expect that as rates come down, some of the existing house supply will get unlocked. And so, while you would normally think that mortgage rates coming down would push prices up, it's not quite so clear this cycle, in the same way as it wasn't clear when rates going up would push house prices down. All of that is very confusing and sort of, I know I'm talking multiple different things. Let me summarize it in a simple way. Even if house prices go back up, there is still disinflation in train, right? 2 years from now, we will have to see what the supply-demand balance is and how home builders respond to oversupply and how potential home sellers respond to falling mortgage rates. There's a lot of uncertainty there.
So what do you see down the road as our deficits continue to grow? Do you see us inflating our way out of that? Do you see any risk of us defaulting on our debt? Or do you see it that we will at some point have a political solution, increase taxes, reduce spending?
So I don't see us defaulting on the debt. The good thing about our debt burden right now is the following. Overall debt in the economy as a percentage of GDP has not gone up. It is the same now that it was 15 years ago. It's just that 15 years ago, a large part of that debt was issued by banks in particular, but the corporate sector as well. So we have seen a deleveraging in the corporate sector and the banks in particular following the financial crisis. And we have substituted government debt for private sector debt. That is good from a credit perspective in the sense that we discovered banks can default, and we know that the corporate sector can default. The government need not default because in an absolute worst case scenario, they could print money to service their debt. So your credit risk is essentially zero. You are taking, as you hinted at, David, inflation risk, right? Because the act of printing money to service that debt would presumably push inflation higher. I don't think that you can truly inflate your way out of the debt. You cannot solve this problem with inflation, right? You can make it a little bit easier to manage by running inflation slightly higher, which again, I think is desirable, not necessarily for this reason, but the Fed's target is 2%. We ran inflation below that for 20 years, right? It is probably better to run it slightly above than slightly below. And I think the Fed recognizes that. Their target is 2%. Their implicit target is between 2 and 2.5, right? That no household, just let me digress for a minute. You know how the Fed picked 2% as their inflation target? They just kind of made it up. I mean, it's not like there was any higher math that went into this. They looked around, they said, what has inflation been? What are other inflation targets? Like 2% seems good, right? Because it isn't really the number that matters. What they're really targeting is a change in the rate, is an inflation rate that people don't have to think about, They just want it not to be an issue. They want it to be positive for a variety of reasons, but they don't want people to have to think about it in their daily lives, and they don't want businesses to have to think about it when they make decisions, right? And prior to the cycle, nobody did, right? You very like inflation days from a market perspective weren't big days because it just, it was kind of boring and it was low and that's what it was. But the truth is, they could just as easily have picked 2.5% and got the same result. No household is going to perceive the difference between 2 and 2.5% in any given year, right? 0.5% difference, it's just not going to resonate. And so if you run inflation at 2.5 instead of 2, it slows the rate at which the debt burden grows without impacting the economy. So I wouldn't be surprised to see the Fed try to run between 2 and 2.5. Their official target is flexible average inflation targeting, which means that during an expansion, they already implicitly tolerate inflation slightly above 2, because during a recession, it's going to be below. So if you want to average it, it's got to be slightly above. So that's sort of where we are from an inflation perspective. What is, so you can't inflate your way out, right? You can't run inflation at 10% to solve the debt problem. You can make it a little easier with some additional inflation. Do I see a political solution? I mean, not in the current environment, right? It has to be bipartisan. It has to be, because this is really unpopular, right? And in order to do it, everyone has to own it across the political spectrum. Everyone has to give a little to get a little. You have to be willing to raise revenue somehow, and the Republican Party isn't. You have to be willing to cut entitlement spending somehow. Neither party is. You have to be willing to cut discretionary spending. The Democrats aren't, so there's just no common ground there. How do you get to a political solution? I mean, I hate to say this, but typically the answer historically has been you have a crisis wherein the bond market breaks and people refuse to buy your debt. And at that point, you have no choice but to come up with some sort of solution. The question is whether that applies to the US or not, because the US is different. This is not an emerging market. The dollar is the risk-free currency of the world. Treasuries are the risk-free asset. The dollar is the reserve currency of the world. There is no evidence that there is a shortage of demand for our debt, even as we continue to issue more of it. The US is different. How different? Unfortunately, I suspect we're going to find out, right? Because I don't see the current environment changing. I don't have a tangible answer for how long we can run deficits at this level. I don't think there is one. I suspect it's a lot longer than most people think, simply because there is no alternative to the dollar as the reserve currency. And so reserve managers around the world have to hold dollars. And if they have to hold dollars, they have to invest in something. Treasuries are still the risk-free asset. So, I could see this persisting for a very long time.
So we have a question about your comment about overbuilding, and is that a local perspective or a national perspective?
That's national, and I 100% don't believe that it's true in Nashville, right? I go down there a lot for because our headquarters are there. I'm based in New York. Everyone down there, look, there are some places in the country where there is not overbuilding. There are some places where there is. I think in aggregate, in hot cities like Nashville, you could add Charlotte, Austin, there are some others to that. There is a distinct shortage of housing. Even in New York, there is a clear shortage of housing. Nationwide, there may not be. And again, from a monetary policy perspective, from an economic perspective, we look at the aggregate, but some local markets are hot without question.
So how do cryptocurrencies play a role, if any, in the economy today?
They don't. They just don't. That's not to say they might not someday. They don't. Right now, they play a role in financial markets. I find them fascinating for what it's worth. I think, though, for investors, it's important to keep in mind what they are and what they aren't. They are speculative assets, and that can be wonderful. You can make a lot of money with speculative assets. They're not currencies. There are very specific definitions of what a currency does and doesn't do, and crypto doesn't do those things. Not yet. It may someday. But if someone wants to dabble in or trade or invest in crypto, I think that's wonderful. But you just have to keep in mind that it's a speculative asset, like any other speculative asset. Think of it as akin to buying or selling gold or something like that. I do suspect that over time, central banks will start to issue crypto dollars, if you will, official cryptocurrencies. And that could be something that is very damaging to the existing crypto market. Look, for existing crypto to really become a currency, it has to become widely accepted. It can't just be me using it. My mom has to be comfortable using it, right? My mom's pushing 80. She might be willing to use a digital dollar. She's not going to use Bitcoin, right? It's just not going to happen. And if you really want something to be a currency, it has to be broadly used and broadly accepted. So I think that's a fairly distant prospect. You know, I forgive me for not getting the dates exactly right on this. The first crypto was launched at the same time as the first digital video recorder for your TVs, right? Every single person you know uses a DVR in one form or another, right? Very few people actually use crypto. So for all the talk about the rapid growth of this industry, it has actually grown incredibly slowly by the standards of tech products.
So what parts of the market will benefit the most from reduced interest rates?
So you would expect housing to be one, but again, that market is so screwy right now that it's difficult to be sure. I think cars are a place where you would expect to see a benefit. That's another area where people do borrow money to buy. I think, though, that the real benefit is lower income consumers. We have seen over the last few quarters a small but a noticeable increase in credit card delinquencies and defaults. Credit card rates adjust much more quickly to rising interest rates than anything else. I mean, if you have a fixed rate mortgage, what do you care what the mortgage rate is, right? But if you have credit card debt, you care very much what the interest rate is on your credit card. And so particularly lower income consumers have burned through the excess savings that they accumulated during the pandemic and are now left funding consumption in an environment where prices are a lot higher than they used to be through a combination of labor income and credit, and the price of credit has gone up. So as interest rates come down, we would expect to see some relief on credit card rates and some relief for lower end consumers.
So David Hossie wants to know, understanding your audience, what are particular actions that would be important for entrepreneurs that are desiring to grow their business engage in?
So I think you need to have a clear-eyed sense of what the interest rate environment is going to be, right? What the cost of capital is going to be, whether you're borrowing directly or not. And so your first question, David, was exactly the right one. I don't think that you should plan on the assumption that you're going to be able to borrow at the rates you were able to 5 or 10 years ago, that you're going to be able to fund yourself at that rate. I just don't think that that's coming back, at least not in a good economic environment. Or to put it differently, if interest rates are back at 2%, it's because we're in a negative economic outcome, we're having a recession. It's not because that's just the level that interest rates are going to be. So that's one. Number two, I think you need to have a business plan that is resilient to potentially dramatically different regulatory environments. The other thing that populism tends to generate is this very dramatic swing back and forth. And we've already seen that a little bit in the US. You go from Obama to Trump to Biden. Let's say we go back to Trump. And then where do you go? You could go to AOC, you could go to Ron DeSantis, right? I mean, the polls just are far apart. And because none of these populist policies tend to generate good outcomes, the electorate tends to vote against the incumbent every time. And so then you just swing back and forth, right? And, again, I won't, presume to speak for your businesses, but when I have spoken to small business groups, established small business groups in the past, what they generally say to me is, we can adapt to any regulatory environment. We can adapt to any tax environment. We have preferences, right? We would like, this, that, and the other in terms of policy. But what we really need to know is what it's going to look like, right? Tell me what the environment is going to be, and I can plan for that. And the problem is, in a populist environment, I can't tell you what the environment's going to be out past 2 years, right? And if you're starting a business with a 2, 5, 10, 15-year time horizon, you better be able to manage those swings. So if you're building a business based on the idea that there's a particular government incentive, or that there is a particular regulatory, think of it this way. How would you feel if you were right now involved, and maybe some of you are, if you had built a business that depends on a transition to electric vehicles, and we're now potentially transitioning to an administration that's going to cancel all of the regulatory impediments to persisting with, combustion engines, and going to cancel all of the government incentives to build electric automobiles, right? If your business plan is contingent on that sort of policy, it's going to be an uncomfortable place to be. So I would emphasize resilience and focusing not on a particular policy environment, because that environment could change.
So the illiquidity of the banks due to unrealized losses in commercial real estate's made a lot of headlines. How do you see that playing out?
So the good news is that I think the banking sector is in good shape, right? As compared to the financial crisis, I think that bank regulatory policy has improved dramatically. I have to say that my wife is a bank regulator and she's sitting in the next room. But I actually believe it as well. The banks are in good shape. Their capital requirements are robust. There has been no evidence, even during the pandemic or in its aftermath, that any of this puts the financial sector at risk, right? Part of that means that they have been more conservative in the way that they are underwriting loans. And that does mean that there is some illiquidity, that they are being cautious as a result of potential losses from CRE and others. JP Morgan's earnings came out this morning, and they held back their largest loan loss reserves in, I forget however many years it was, because they want to be cautious about these potential losses. It doesn't mean that they're catastrophic. It just means that they are conservative. And what we have observed is that as the banks have become more cautious, more conservative about extending credit, private sector credit extension has gone up dramatically. Private credit is the hottest part of financial markets, just about. Non-bank lending has been a huge growth market for us, but also for others in the industry. Adam can tell you more about it, I'm sure. But private creditors, private lenders have stepped forward into the void left by the traditional banking channel. It makes me nervous to some extent, because the pitch there is that they can move faster and are less subject to regulatory oversight than banks, which makes one wonder about the underwriting standards in some cases. If your marketing pitch is, we can give you money quickly and we're not regulated. As someone who used to work at the Fed, I'm not sure that makes me feel warm and fuzzy. But I think it is a good thing from a systematic perspective to have that risk distributed. You'd rather have $1 of risk with 100 private credit lenders than $100 of risk sitting at JP Morgan.
So Gary Wisniewski wants to know what your thoughts are on BRICS.
I think they're dead, gone, and buried. So let's go through them one at a time. Brazil. So the BRICS were a concept, emerging markets. They were going to drive the global economy on a forward basis. Became very popular 15, 20 years ago, largely because it has a wonderful acronym that everyone can say, but also that it did seem like a way forward. These were countries that were progressing, that were playing a larger role in the economy. Brazil. Turns out that really what they're very good at is exporting soybeans and hedge funds. That's really their two leading exports at the moment. Their policy framework never evolved in a way that allowed them to move beyond sort of extractive technology. And as a result, their domestic capital has left, as I said, through hedge funds and other investment vehicles. They have had underinvestment at home. The policy environment, again, this populist thing, they've bounced back and forth, left, right, Lula, going the other way and back to Lula again, and never really have developed in a way that allows them to play a leading role in the global economy. So that's them. Russia, I'm not going to spend a lot of time talking about Russia because nobody in financial markets does either. It's untradeable. India is the hopeful story here. I talked about demographic trends and the aging of our workforce. It's not just a US story. It's a story about the whole developed world. Everywhere in the world has poor demographics, except for South Asia and Africa. And India is the most developed, most advanced of those economies and the largest. India's growth is strong this year. We marked up our global growth forecast just because of India, frankly. It's still not a great forecast relative to history, but for India, things look pretty good. That said, the development of infrastructure has been very slow. They have not become a true global powerhouse. They are at least progressing. China is the flip side of that, where the demographics are terrible. The population is aging. There's no social safety net. There are no savings vehicles. And as a result, people in China viewed their housing market as the best savings vehicle and fired money into the real estate market, which is now weakening because the population is aging. So China is a global power. It will remain a global power, but they are going through a difficult transition that has set back their effort to take a step forward, if you will. It is an environment we cannot ignore. I'm actually going to China in a couple of months to visit our offices there. But I think that the hopes that they would be the dominant driver of the economy, that perhaps the Chinese renminbi would be the alternative to the dollar as a reserve currency, has not come to fruition, right? So these countries as a whole have not stepped into the role that you would look for them, that many people thought they would play 20 years ago. And for what it's worth, investment in emerging markets in general has struggled this cycle. US interest rates at 5%, corporate interest rates higher than that, mean that the hurdle rate that investors need to see in order to make emerging markets look appealing is pretty high. And that has constrained emerging market growth. On a forward basis, as I said, the places that I think that are worth focusing on, you can't ignore China, but India and Africa are the places with the biggest growth opportunities.
So I feel like what saves us a lot of times is the rest of the world's more screwed up than we are. And maybe that's the only thing that saves our treasury, sales from being at risk. But do you not see any potential where as our balance sheet gets more and more upside down, that there comes a time when our treasury salespeople say, no, that the risk requires
Yeah.
a higher reward, and that would cause an inflationary spiral?
So look, you're right. You know, the market acronym for this is TINA. There is no alternative, right? And so when you look around the world, if you want to find a reserve currency for the dollar, it has to be able to do the following things. It has to be freely traded, right? So right there, you knock out China because their currency is not freely traded. You knock out Japan because that one, they intervene, they manipulate it. It has to be representative of a large economy, or else there isn't enough of it. So you basically rule out almost everyone else. Its value has to be stable. That doesn't mean it can't go up and down, but it can't be particularly volatile. So, for people who talk about crypto, I mean, that thing swings around 40, 50, 60%. No reserve manager is going to feel safe sticking their money in crypto. And anyway, crypto assets don't yield anything. So there is no plausible alternative to the dollar right now. And that means the treasuries still find demand. That doesn't mean, though, that you're wrong. I do think that as more of it is out there, the price that investors are going to demand, the return that they're going to demand to take the risk as our balance sheet deteriorates, is going to be higher. And that's a big part of the reason we expect interest rates to stay higher than they were in the past cycle. A lot of times when people ask about the debt, what they're really asking is, aren't we going to have a crisis, right? Aren't we going to have an emerging market style crisis where the market just concludes our fiscal position is intolerable and there's a buyer's strike and yields don't go up from 4 to 5, they go up from 4 to 40 or something like that. And I don't think that that's very likely. But I do think that we are going to have a higher interest rate burden and higher interest rates as a result. And that's a headwind to growth, because every dollar that the government spends servicing debt, every dollar that they spend paying bondholders is a dollar that they're not spending on bridges and tunnels and 5G or 8G or 10G or however many G we're eventually going to have. It's not productive investment. I would rather have private sector driven investment. And that's better than public sector investment, but public sector investment is better than nothing. And if what you're spending money on is servicing bonds, you're really getting nothing. So I think of it as a headwind to growth. I think that it becomes more challenging over time because as interest rates go up and stay up, the burden gets even higher. I don't think that it is likely, though, to cause the kind of crisis that forces a political realignment to deal with it, at least not across a reasonable forecast horizon. We're kind of stuck.
Okay, I think this is going to be the last question. Chris Quay wants to know, how do you see China's declining population affecting the global economy over the next 2 to 3 decades?
It's an excellent question and probably one of the most important ones. If you look back at the last 20 years, I think the driving variable in the global economy was China coming online. The China joining the WTO and joining the global economy, providing this massive workforce, allowing businesses to produce much more efficiently. That's a big part of the reason inflation stayed below 2% for a very long time. It's a big part of the reason financial markets performed as well as they did. It generated, a positive supply shock on the labor side is a very positive thing for growth. It's no question about that. They're going the other direction. That means that China will not be able to export cheap labor essentially to the rest of the world in the same way that they did. It means that their own domestic labor is going to be in shorter supply and will presumably need to be compensated more highly, that more of their money will need to stay home to support an aging population, that their government, one way or another, will have to come up with some sort of a social safety net to prevent social disorder. It's just not going to be tenable for every one Chinese worker to be supporting 2 or 2.5 retirees, not at the current level of compensation that employees receive there. So you're not going to have that positive boost to the global economy. If anything, you're going to have a negative boost as China pulls in capital rather than pushing it out. I guess a negative boost is a drag is probably a better way to say that. What does it mean from a global perspective? Look, the demographics are what they are. And I said earlier, the 2 regions of the world that are in a different position, that see a young population and an expanding workforce, are South Asia, so India, Bangladesh, Pakistan, Indonesia, and some of the smaller countries in that orbit, and Africa. And so the question for the global economy to answer is, can those regions step into the void created by China pulling back? I'm skeptical, but look, I'm an economist. I'm skeptical of everything. It sort of comes with the territory.
Well, that's a full hour of having our heads spinning and trying to wrap our brains around this. It's been fascinating, and we really appreciate you guys. And I know Forum 3 is looking forward to having Adam come talk to us in next month. So I hope everybody remember to get them in your forums and learn more about what we've got going on the next decade or so. So guys, thank you very much for this. It's been great, and everybody have an awesome weekend.
Thank you,
Thanks for having
everybody. Have a good weekend. Bye.